the only 3% of new construction is under $250,000 in value.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I'm so glad you're here with us again today. I've got another amazing guest with me, Peter Neill. Peter, welcome to the show.
Jeremy, it's great to be here. Thanks for having me.
Likewise, I'm looking forward to chopping it up with you here today. Peter's the co-founder and partner at GSP REI, a vertically integrated owner-operator specializing in the development and redevelopment of much-needed single-family workforce and affordable housing communities. Peter, there's been a lot of buzz out there on social media, in the media. Certainly the politicians are talking about it and even campaigning on different platforms as it relates to, how to solve the affordability crisis in America today. So with all of that said, would certainly love for you to give our listening audience a little bit more information about your background, your journey, what you're focused on today as it relates to the affordable housing space.
Yeah, Jeremy, that's like you said, it's certainly becoming more and more of a buzzword in different areas. It's not just the real estate investment space, but politically, on a state, local, federal level, there's a massive need for more affordable housing, whether that means subsidized or not. I think there's a ton of misconceptions around the space, workforce, and affordable housing. And it doesn't always mean subsidy. So kind of depending on, where you were introduced to the space, some people might think it's just subsidized housing and it's war zones, that kind of thing. But these are, I like to call it essential housing. So, and you hear that term every now and again. But or missing middle is another one that you hear a lot, so, but to answer your question, to give like a little bit of an overview, I got started in real estate right out of college, and I was really fortunate to take a job at it was a distressed mortgage investment company, but it was advertised to me as like a real estate investment company. And the CEO of that company was is who I worked for and worked with on a daily basis. And he didn't just do distressed mortgages. He did a lot of, he owned a pretty sizable single family portfolio. And so I kind of credit him for the introduction to our strategy today in a lot of ways. But my partners, like my partner, Ron, he had been doing this for years. And he started as a builder. He was a general contractor. 20 plus years of construction experience, and he was doing, this exact strategy. And for me, I was looking. I always joked I wanted to instead of working for the CEO, I wanted to be the CEO more, more than anything. So I was fortunate to, through the connections, meet my partner Ron. And kind of the original thing was for a sports complex development. And in getting to know each other, I found out what he was doing with affordable housing. And that was something, going back to that introduction from the CEO, like, these were really good investments in the single family space, small multifamily space, even large multifamily space can make a lot of sense because of the supply and the demand metrics in that space. So we got to know each other. I got to really understand how he operated and his crews and all that kind of stuff. I'm talking about my partner, Ron. And we partnered in 2019. We launched our first fund November 2019, and we've just been growing the portfolio ever since. We mainly focus on rental. So what we do is we buy, fully dilapidated homes for the most part. We do some value add as well, but our bread and butter is those fully blighted properties, something we can pick up at a very significant discount. And then through our in-house construction, we'll go in, we'll renovate the property. So it's like new construction. We're just practically rebuilding within the four walls. And then most of the times, what we'll do is we'll lease that property out. Sometimes through a subsidy program, sometimes not. Just through market rent. And then from there, we'll continue to lease them out.
Yeah, and Peter, how would you define what workforce housing, what that demographic is that you're catered to versus maybe, the affordable housing, lower income housing, what would kind of constitute that particular, demographic, and what really, drew you to that space? Is it just that you see the tremendous amount of opportunity that exists, catering to that audience, or are there other factors?
That's a big part of it. To answer your first question, I would, me personally, I would define workforce housing as a kind of like a subset of affordable housing. Essentially, it is affordable housing. When we look at affordable housing, we look at it the same way HUD does. So we want our tenants paying less than 30% of their gross income towards their housing cost. Now that could be achieved through a subsidy, or it could be achieved just naturally, through what the rent is versus what their income is, that kind of thing. And essentially, workforce housing kind of, it takes it one step further in the sense that your main customer is somebody who is living and working in the area, or they're commuting to a job. So like we do a lot in Baltimore, and a lot of people in Baltimore in certain pockets of the city commute into Washington D.C. There's a ton of jobs in the DC area, but it's extremely expensive to live there. So a lot of times, in good areas, where there's a lot of economic opportunities and jobs, they've priced out a lot of the regular workforce in the affordability of rental costs and housing costs, that kind of thing. So it forces areas, to then provide housing for that workforce. So you want to be close to transit. Kind of our little bit of our secret sauce, something I wish we were smart enough to do this purposely from the beginning, but it was something we picked up over time and have really leaned into it. We invest a lot around hospitals. So hospitals, they're typically rooted where they're at. Hospitals aren't going to just pick up and move. So they're typically very rooted in where they're at, and they do a lot of what they call community investment. And this means different things for different hospitals, but the hospitals that we tend to invest around, they do a lot of, they own properties. They're revitalizing properties for various reasons. To house different people that work for them, and different people that go to the hospital and stuff like that. And then they invest in the community in other ways too, through different programs and through local businesses and things like that. So they want to be in vibrant, areas that are heading in the right direction. So we've it was something we kind of noticed. I mean, wow, we tend to be investing in these certain pockets. Why? And nearly 90% of our portfolio tends to be in a pretty close proximity to a hospital. So areas like that, where it's they're heading in the right direction from a revitalization standpoint, from a crime standpoint. I mean, that's one of the things you tend to look at very closely when you're dealing with affordable housing, and in urban areas, because there's certain pockets that are always going to be better than others. But essentially, it's missing middle is a good way to put it as well. You know what I mean? So it's kind of spreads the gambit between low income housing to more middle income housing. Whereas with low income, typically for us, it's going to be achieved more through a subsidy, like a Section 8, where the tenant's receiving that, versus middle income, where we can get into that 30% or under range just through the rent, the regular market rent, versus what the tenants are making. So that, I would say, that's the definition. And then why did I get into it? My bread and butter for me is, and where I am at heart, is a fundraiser. So when I started at the company I was at before this, I was on the sales and marketing side, and really grew their investor relations department. So I liked affordable housing, workforce housing from a fundraising perspective, because I saw it as something that isn't as cyclical as a lot of the other options are in real estate. There's certain, especially commercial real estate, with how they relate to interest rates and things like that, where they're at with supply and demand from a development perspective, it tends to go up and down a lot. And workforce affordable housing is so undersupplied that it kind of insulates it from a lot of that cyclical craziness. There's demand in any market. There's a lot of demand in this market, and it's grown over the years with inflation and interest rates going up and things like that. So and the opposite is true too. If there's a downturn, recession, that pool of tenants that needs that type of housing tends to get larger. So it's something I saw that I could be raising capital for this forever. It's just, and it's unfortunate in a lot of ways too. Because unfortunately, we're really not doing anything on a state, local, federal level that's creating a ton of more affordable housing, and a lot. And there's different reasons for that, and a lot of it in the urban areas is it's the built environment. So you're not going to go into these cities like Philadelphia, Baltimore, and just develop huge tracts of land, for new housing. It's built out. There's not a lot of opportunity for that. So you have to be able to take scattered site, single family properties and revitalize them, individually, that kind of thing. And that's kind of the other reason we got into this. My partner Ron, like I said, he'd been in the construction management GC space for 20 plus years. There's guys on our crew today that have been with him for over 15 years. So, and they were very skilled in single family, and working in the cities that we're in now, and the suburbs that we're in now. So it was one of those things where we felt like we had the crew to be able to execute, and I think that's a lot of times why people scale up to multifamily is they don't have the ability to do construction on a large scale, across different cities and different suburbs and things like that. So utilizing third party property management, having that initial economy of scale with 100 units, 200 units, there's massive benefits to that. And it's the same. The economy as a scale is the same in single family as well. You know what I mean? So for us, that's why we're looking to do this at a larger pace than maybe the average mom and pop business will, because I think there's benefits to staying small like that, because you can manage it. It's especially if you're balancing your other life and responsibilities and things like that. But from a company perspective, beyond just the portfolio, there's opportunities to scale the single family side of the business. And you're seeing that now more and more with companies like Invitation Homes and American Homes for Rent and all. They have some aggressive goals. They already have hundreds, thousands of units under management. They have aggressive goals to continue to do that in various ways. So,
Yeah, I appreciate that. And thank you for your perspective on that. And I wholeheartedly agree with you on your synopsis related to kind of that workforce housing, demographic. As I think about, that essential housing space, as you call it, or that missing middle, I am curious to know, are there any government related incentives for investors like yourself to improve, the lives of tenants that live in this kind of quote unquote missing middle?
yeah, sure. There are. We do not. There's a lot of red tape typically around the government programs and things like that. So we're starting to explore some of those avenues with the cities that we operate in, with accessing properties and land through their land banks and that kind of thing. But there's a lot of red tape around it. It's for us in where we're located at and all. There's a ton of privately owned properties. Like Baltimore has, I think it's upwards of 18,000 vacant homes, 20,000 vacant properties, and 90% of those are privately owned. So it's actually it's kind of there's a putting the efforts towards marketing and finding properties on and off market that way has tended to be more fruitful for us. Now you can typically get in at a very good basis when it comes to acquiring or being or receiving properties from the land banks and things like that, but there tends to be a lot of red tape around how they can be constructed, restrictions around rent and for sale prices and things like that. So we have some things going in both Philadelphia and Baltimore exploring those. But over the last 5 plus years, our main focus has just been acquiring privately owned properties. There's also opportunity zones and things like that. But in the areas that we're in, I think our average tax bill is it's under $1,000. So it's not like like in Texas. I've heard of people having some really great success in those areas where the taxes are a lot more expensive, and that really fuels the development and redevelopment, and makes it worthwhile from a income perspective. But for us, it's the tax bill is not a massive issue for us right now. It's something you always look at, but and then same thing too, the opportunity zones. it restricts the deal, where you have to have a certain amount of people. We've looked at different developments where you have to finance it through local lenders for a certain percent. You have to use union labor, which a lot of times makes these jobs not, not doesn't pencil out. I mean, it just makes them not feasible. So there, to answer your question, yes, there definitely is. We are starting to explore some of those things now, but our what we've been mainly focusing on is private sales, and then the subsidy programs through Section 8, like they're based on the tenant. The tenant's the one that gets those and all. We make the properties available through the city's programs and websites and things like that. And the city suburbs all kind of do things a little bit differently. But it's not like a HAP contract or something like that where the subsidy's tied to the building. For us, it's always tied to the tenant.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Peter, I'd like to double down on something that you alluded to earlier, and that is as it relates to being a recession-proof asset. My question is why do you believe workforce and affordable housing remains one of the most recession-proof asset classes for investors?
Yeah, well, the data shows it. And so if you look at Nuveen, they are the real estate investment division of TIAA, and they've done a ton of research. They own like one of the largest affordable housing portfolios in the country, if not the largest. So they've done a lot of really good deep dive data on affordable housing versus market rate housing versus retail, office, industrial, all your different flavors of real estate. And affordable housing tends to do better, has done better in over the last few recessions, 2008 especially. And I think a lot of it just comes down to is the demand. So there's a lot of demand in this space in a normal market, and during downturns, recessions, you tend to see that demand get even larger because there's just more people that need that type of housing, and maybe they look at where they're at in a class A, luxury building, and say to themselves, I might need to downsize in order to make life more affordable, that kind of thing. So I think a lot, and then just supply, a lot of times from a feasibility perspective, the new developments tend to have to go more towards class A luxury because they really need to maximize the income um, because of land costs just being so expensive, building costs being so expensive, just the entire development process being expensive. It forces most projects to end up being, I think the average home over the last 12 months or so was built for about the only 3% of new construction is under $250,000 in value. I mean, so you can see that like, we're really not building new homes when it comes to that, the lower end of the market from a value perspective. And there's a lot of reasons for that. It's not just greed, it's like developers want to fill the value, they want to provide and fill the void and provide what the market wants, but it needs to be feasible at the same time. And really, between land cost, construction, labor, materials, and then just overall, development cost with the zoning and attorneys and all that kind of stuff, engineering and all, it just tends to force new projects to be, more on the higher end of the scale and closer towards class A and B, that kind of things. So that's where there's just not a whole lot of new supply coming. And then, like I said before, when you're in these urban areas, they tend to be built out. You know what I mean? So you do see opportunities to create like an assemblage of row homes and stuff like that. But it's harder to do, especially in the areas you want to be. Maybe in war zones, where it's just like it's mostly, and when I say war zones, I think some advice to the listener is we want to invest in areas where we see regular people buying homes. You could typically, if you drive through a war zone, you typically know it's a war zone just from your eyes. But but a lot of times too, only investors are buying in those areas. You're not seeing a lot of regular people buying homes in those areas. We want to be in areas where you're seeing a lot of regular people buying homes. And then we don't necessarily have to compete with them because we're buying those fully blighted, dilapidated homes. Most people aren't going to buy a home and put $100,000 into it. And then they got to stay where they're at and deal with the construction and all that kind of stuff and the construction loan. And that's a hassle. Unless you're a contractor, most people don't do that. So, but then they will buy a fully, practically new construction home where everything's new and looks great. So we love that. It gives us the option to lease it or to sell it on the market to a regular home buyer.
Yeah, I appreciate, Peter, your perspective there on recession proof assets, specifically in the affordable housing workforce demographic population. I'd like you to now speak to maybe that passive investor, which we have a lot of those individuals that are regular listeners to this podcast. What are some of the maybe biggest mistakes that you see passive investors making when entering into, real estate syndications or making passive limited partner investments, in real estate? And how would you encourage these individuals to avoid, those pitfalls?
Wow, yeah, that's a really good question. And I deal with a lot of investors, some that are very, very savvy, and have during K1 time. I like to joke. I mean, they got 50, 60 different K1s coming in. I just think, God, their head must explode. And then others that don't. I mean, it's kind of like this is an alternative to the stock market, and like they don't do a ton of different alternative investments, but I think it really comes down to investing in what you know, and that could be tough because you might not know anything. You know what I mean? There's some people, depending on where your job is, sales, if you're an attorney, if you're a dentist or doctor, engineer, whatever it may be. You might not know anything when it comes to the investment side of real estate and all. So I would say, try to find something though that interests you and something that maybe is a little bit of an easier thing to understand. And I think that's where I think single family is great, multifamily is great in those senses because chances are you lived in a single family home, right? I mean, you lived in an apartment, so you can understand and wrap your mind around why people lease these types of properties. I've been involved in commercial transactions, especially on like the industrial side. If you're leasing flex space or something, and you think, who the heck's going to lease this out? You know what I mean? Like, so it's like things like that where if you're in that space all the time and maybe you grew up around it or you had office space in a place like that, or you work somewhere like that, and you can wrap your mind around who those tenants are going to be and what they want and all, then I would say explore that, you know what I mean? And really get to understand that. And just like anything else, you know what I mean? Like, cause we look at it too as active investors and operators, getting really, really good at one thing and really understanding the macro, issues around it, but the micro too. I think probably a mistake a lot of investors make on the passive side is they just focus so much on macro trends. And that's good for certain to kind of give you a certain direction on where to go and where the market's going and what to invest in. But real estate is so hyper local, it's so specific to the area, you know what I mean? So I guess, there's just it's such a big question because there's just so many things that go into it. But I think you probably want to look at things from somewhat of an active, you got to be like an active passive investor, at least for a little bit, you know what I mean, until you get comfortable with what it is you're doing, how to read the documents and to analyze deals and things like that. And then don't be afraid to build a relationship with the person that you're investing in. I think I always love the people that ask great questions. Like it just shows that they're more interested. When we do review calls and things like that, they're going to show up. Like I love those types of investors because you learn from them. You know what I mean? And it's just more fun. It's just like it's when there's interaction between the team and the investors and all. I just find it to be more fun. So don't be afraid to ask questions. Don't be afraid to ask stupid questions either. I mean, something you might think is dumb. And I always think of my mom with this. My mom was a school teacher for 35, 40 years, forever. And she would always say, there is such thing as dumb questions. I mean, people always like to say, but it's usually the one that somebody just asked 5 minutes ago, but you weren't paying attention. Other than that, don't be afraid to ask questions. I've had amazing conversations with investors around what's the difference between debt and equity. You know what I mean? And what, just silly question, like something that you think like, oh, like you might be afraid to ask or something like that. I mean, don't be afraid to ask. And then because too, like it starts the conversation, and you never know where the conversation is going to lead you. And I just think you really want to try to really understand what you're investing in at the end of the day. So there's no surprises. I don't like surprises.
Yeah, no, I appreciate that perspective and agree with you wholeheartedly, that passive investors really need to be active investors as well. This isn't just about, chasing after the, highest IRR or shiniest pitch deck. I really like, what you said about, investing in what you know and who you know, right? And being willing to ask questions. And the truth is that a lot of busy professionals out there today that do not know about private placement, real estate, syndication type investing in the alternative sense, the truth is that, Peter, a lot of them don't even know what questions to ask, right? And so giving them that forum to be able to listen in on and educate themselves further, whether that's recommending certain podcast episodes or recommending certain books to read, all those things can be very powerful, on a novice investor's journey to become more, sophisticated and educated, in the space. The truth is that most busy professionals today really just listen to what their financial advisor tells them or listens to what their friend Brad tells them, right?
Yeah, sure. You get a lot of that, and I would say too, like, don't be afraid to glean uh, insights from your own foundation. And what well, and like what if you're an accredited investor, you've had some success. And look, examine that. I mean, take the time to examine what's worked for you from a skill set perspective. I mean, all that kind of stuff because that's only going to be helpful. It by no means is it is it going to hurt you. You know what I mean? Like if you look at because that's going to tell you what you value and what's important to you and what's not. And one piece of advice I would give because we were talking about podcast interviews and stuff like that. I've done a lot of podcasts with different like LP advisors. So I'll say like quote unquote because they never want to be like say they're specifically an LP advisor, probably because of some responsibility or something like that. I would say listen to all of them. You know what I mean? Like, don't just hop on one's coattails and ride that into the sunset because the more you listen to them and the more you talk to all of them in that space, and I've talked to a lot, they tend to all have different, it all comes back to their personal opinion at the end of the day. I mean, because some of them will tell you, I would never invest in a deal that did this, or I would never invest in a deal that did that. And then you go talk to another one and they tell you, oh, I don't, that doesn't bother me. I mean, there's no reason why. I actually like it when somebody does this or that or whatever, or if it's structured like this. So I would say, listen to all of them because you're gonna pick up, tidbits here and there. You know what I mean? Like, but listen to all and what resonates with you, what you like, and that's where it's really important to know yourself and your foundation because you're gonna have a different risk appetite than somebody else. It might, you know what I mean? And two, your goals are gonna be different. I mean, I have some people who are retired. Who are looking for passive income, they want mailbox money, that kind of thing. Other people that are working on a W-2 job that makes 400, 500, 600,000 a year plus, they don't need the passive income or they do want the passive income because they're looking to replace that job over time. You know what I mean? So people just the goals can really, span the gambit. You know what I mean? So it's like that's where I would say start with internally. I mean, start with yourself and really know what it is your goals are. I mean, what do you like? What do you don't like? What can you sleep at night with? All that kind of stuff. Listen to others. I mean, try not to judge up front. Take it all in, and then kind of stew on it, and take with you what resonates with you, and don't be afraid to dump aside what doesn't. I mean, because it's just funny. It's one of those things that's in my mind recently because I had a few of them, and it's just funny how you listen to different people that just tell you completely different advice. I mean, so it's like you got to at the end of the day, you got to make the decision, and that's where I think the personal development side is not to be forgotten in this space. You know what I mean? I think you always want to be balancing the logical decisions with the emotional ones. And because a deal could make sense on paper and be very logical, but from an emotional standpoint, if you don't have the right operator that has the right experience, and even I even hate to say that, because there's people that maybe don't have all the right experience. I talked to somebody a couple weeks ago who was looking to get into something, and this guy had the right attitude. You know what I mean? Like that could mean something to you. But other people might say, "Screw attitude. I want 20 years of experience or this or that." I mean, so it's like that's where you really have to know yourself and how much you're looking to invest, and then you want to be diversified to some extent. I think you can be over diversified, but I think in the passive realm, it's good to be diversified in some ways. You want to diversify, just like how we own different properties and different streets and different cities, different states, all that kind of stuff. You want to do the same thing with your fund managers. I think that's important.
Yeah, absolutely. And amen to that. Peter, this has been a very high value conversation. So I really appreciate the support that you've given to our listening audience today and the value that you've brought. Is there maybe one or two different ways that our audience can connect with you to learn more about what you're up to?
Sure. I would say start with the website, gsprei.com. There, they can schedule time with me. I always say reach out. You can schedule time right through the thing. I think my contact info is on there too. So always feel free to reach out. Let's have a conversation. I do some stuff on LinkedIn as well. So Peter Neill, Neill. People tend to get that wrong. So it's always see what L or an A will pop in there every now and again. So Peter Neill, Neill, and gsprei.com. Great place to be.
That's great. Well, we'll put those links in the show notes for the episode. Again, Peter, thank you for joining us today.
Jeremy, thanks so much for having me. This was a great time.
Absolutely. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.